Hey guys, we're finally here. I'm finally doing a USD JPY video. I've been talking about it for the past week and a half, and now finally, it's Saturday the 29th of September, and I'm finally sitting down to do this video. The reason it took me so long to actually get this video together is because this market really has been the gift that keeps on giving. So originally I wanted to talk about one particular opportunity that was a really great one, but then the structure continued, more opportunities were coming, and I thought, you know what, let's include that in the video, let's include this one and this one. And then suddenly, what was originally probably going to be about a 10-minute video is now going to be a very long one. So brace yourself, grab yourself a cup of tea or coffee, sit back and relax and get ready for what's probably going to be a long and slightly unstructured video. Basically, in this video, I'm going to be talking you through 4 trade opportunities that came up in the past week and a half. I'm sure there were many others out there, but these are ones that either I picked up or our members picked up that you may have seen posted on the forum if you're a course member. And the ones that were picked up by our course members that I didn't pick up, one of those is one that I chose not to take. I didn't think it was a good enough trade. And one of them, there's a bigger lesson there which I want to talk about in a lot more detail. So as I said, it's going to be a little bit unstructured because I want to talk through so many different things. I'm going to try my best not to forget anything that I wanted to mention in this video, but let's see how it goes. So first things first, let's refresh our memory back to a couple of weeks ago. I think it was the technical analysis video on the 16th of September. So if you want to go and watch that one, feel free to. But basically, I'll talk you through what the situation was. I've got my drawing tool here, so let's make use of that. So that technical analysis was when we had closed at this candle here. So that was the bullish close, the type 1 on this 127.2 over here from the range that goes A, B, and the C point confirmed as a type 2 there on the 50% level, as well as the type 1 down there, but that doesn't really count that much. So at that point in time, we were obviously a type 1 on that significant level, the extension level. And obviously we know, if you know about the Duomo method, which by the way, if you're not familiar with the Duomo method, then this video is probably not going to be as helpful for you. So I'll leave some links in the description box so you can go and check up on what type 1 and type 2 closes are, significant levels and all of that kind of thing, and it will make more sense. You might want to sign up for our Inner Circle mailing list. It's free to join and you'll get access to our 4-part video mini-series, and we'll talk you through all the stuff in that, so it'll make it much clearer for you. But obviously if you're learning the Duomo method, and especially if you're a course member, then you're going to pick up on all of the things I talk about here. So as I said, we closed as a type 1 on that 127.2. So a type 1 close at a significant level is obviously a situation where we're expecting some sort of reaction. We'd expect after a bullish close like that, a bearish reaction, although obviously it's just a single confirmation, not a double confirmation, but you still expect some sort of reaction. So what I was saying is that I would not trade this level. That wouldn't have been a high activity area for me to trade, but what I expected to happen is that there'll be some sort of reaction. And what I like to do in these situations is just sort of walk through the logic of the levels. So by walking through the logic of the levels, then we get to a situation where we say, okay, there's a good chance there's going to be a reaction at this level. The price is going to move down, but it's going to reach the top of this range very soon. And this top of this range is particularly strong because not only is it a confirmed range, A, B, C down here, and that obviously makes the top of the range a significant level, but you can also see it's been confirmed again and retested and failed at least 2 more times. So there's obviously the initial failure there, which did create a swing high as well. There's this type 3 failure and a type 1 failure. That's a tiny wick that you maybe can't see. So that's a strong significant level there, as well as being a confirmed range. Now there might be other levels there that would make it even stronger, but for me that was enough that I said, you know what, it's going to probably move down here, it's going to fail at that level before it pushes up towards the 161.8. And the reason this level up here was so important for us is, first of all, like I said, it's a well-confirmed range, A, B, C, which means that the significant levels, the extension levels are particularly significant for us. But also on this occasion, you can see if you look to the left, over here, this red line that's coming from this swing is a strong swing high. The reason it's a strong one is because you can see it's the top of this medium wave. So it reaches this point, reverses, that was the peak of that wave, which makes that one a strong significant level. And it just so happens that that 161.8 is exactly in line, more or less, with that swing high, which in those situations makes us feel that the level's a lot more dependable. This happens a lot when the Fibonacci ranges are correct. They will be in line with swing highs, which may have also been previously a significant level, an extension level from a Fibonacci range, but those are extra significant for us. And if we get a type 1 or type 2 close on a level where there's two of them like that, a confluence, particularly with the swing high combined with the Fibonacci, not necessarily with the trend lines, because in this case it's two static levels, although it's created from the dynamic range here. It's two levels that are on exactly one price level, and they happen to be pretty much the same price level. That's beyond being a coincidence. So the type 1 or type 2 close, again, makes it even more like it's beyond being a coincidence. It's actually happened for a particular reason, and therefore it's a strong level, it's dependable. Now, throughout this whole video, there are some points, some principles that I want you to remember. Now, some of you already know this from the course and from the forum and whatever else, and some of you will know it just from in recent videos. I've mentioned it quite a lot. But first of all, when we're assessing the significant levels, broadly speaking, there are two things that we're looking at. We're looking at, firstly, the strength of the level. So let's put strength. And the second point is how dependable the level is. So I'm going to put depend. That looks like a P, it's a D. So we're looking at how strong it is and how dependable it is. So first of all, how strong is it? What we mean by this is once the price reaches the level, whatever it is that we're trying to do, whether it's a reversal or if it's going to be a breakout, whatever the reaction is going to be a strong one. So let's say it's going to go down like this rather than being like this, like hovering around and just reversing a little bit before coming out. So this one would be a strong one. Now that looks like I've just drawn the Blair Witch sign, which I don't know if that's a bad omen for us. So let's get rid of that from the charts. So that makes it a strong level if it's going to have a strong reaction. But just because it's going to have a strong reaction doesn't mean that we can depend on it. What I mean by this is that you can see the previous times that it's reacted to that level and say, okay, if it does react there, it's going to have a strong reaction. But what happens if it's a 10% chance of reacting at that level? It might be strong, but the chances are it's not going to do what you expect. 1 out of 10 times it'll do what you expect, but that's not a lot. Instead, it's that second point, the dependable, how dependable the level is. So it might not be a strong level, but if it's dependable, we can at least have some confidence that it's going to do what we expect it to do. So for example, this level might not be strong, but it's dependable, it's going to have a reaction. Every time it's approaching, it's going to have a reaction. So when you have a combination of the two of them, it's strong and dependable, then that's a perfect combination. Of course, it's always still probabilities. So if it's dependable, and let's say that's like a 70% or something, there's still a 30% chance that it could fail, but 7 out of 10 times it's going to do as we expect, and the chances are it's going to be a strong reaction. Okay, so I just wanted to cover that there. So what we have here is a dependable level because the two levels are in the same place, which means that we know that it's like the chances increase of it being a significant level. There's less chance that we picked out the wrong level there. It's happened for a reason, or in most cases it has. Obviously, it sometimes can be a coincidence. We just have to accept that. But that makes it dependable. It's strong because it's a strong swing high, because it's not just any old swing high. For example, this level here, that's a good swing high. But if you came back down to that price, you can see it's not like the higher high right now. It was previously a higher high until it got broken through. But at this point in time, from these medium waves, let's say that is one, from these medium waves, this was the higher high. And at this point in time, down here, we hadn't broken through that yet. Obviously, we can see what happens next, but just try to ignore that for the sake of this video. So that makes it a strong level, because if you're going to fail there, it's going to have a strong reaction, because at that point you're creating a lower high, and that means that it's capping out the top of this wave, which means it could head down like that. So it's strong and dependable. As well as that, to make it even stronger, we have a range that's not only confirmed, but confirmed more than once by these failures up here. Okay, so I think that I've explained that one to death. If anyone doesn't understand any of that I've just explained, leave a comment or a question below and I'll answer that. And while we're at it, then if you like this type of video, hit the thumbs up button so I know, because one thing that I'm keeping in mind that I might do now that we're starting a new month is to post every trade that I open to explain the situation. Even if they're very short videos, if you'd like to see that, hit the thumbs up, maybe even leave a comment down below saying, yes, Nikki, I would like to see those videos. So let's see what the reaction is there. So anyway, based on everything I just said, we, let's say, predicted that the price was going to reverse from the 127.2 and either on a different day or on the same day come off the range. And that's exactly what happened. You can see that when the markets opened that week, it gapped down a bit. That put us even closer to the level. It was a bearish candle. And then on that next day, we moved down there before coming back up and closing through the 127.2. Now, the thing we need to know about significant levels, and it's especially the case for strong ones, and remember, we've seen that this is a strong level up here, is that they don't just, what we say, repel the price, which is like reverse the price. They don't just push the price away from it. They also attract the price to it. So the price, if there's a significant level, a major one, just above where it is, there's a good chance that price is going to move towards that level. It's going to want to touch that level before anything else happens. So when we closed through that 127.2, we said there's a good chance it's going to come up to this level up here. Now, the next thing, there's another sort of set of principles I want you to understand, which is the set of principles that we use for assessing a trade entry and a trade exit. But these principles individually also help us for assessing an overall scenario, like the context of the situation. The reason I'm getting all these out of the way now is because once we go into the trades, it's all going to make a lot more sense. We can get through it quicker. So when we're assessing it, you may have seen this in videos before, but there are basically 3 things that we're assessing. See if you could pause the video and guess them. You probably know already if you've been watching our videos for a long time. But the first one will be the setup itself. So the setup means the double confirmation. Obviously, if we got up here and got the type 1 or type 2 on these levels, that would be a setup. So that's the setup itself. The second one is the structure. When we talk about structure, we're talking about the wave structure. So for example, these are the waves here. We can see as we're getting up here, we're either going to fail at this point and create a lower high, or we're going to push through and create a higher high. There's also the smaller waves going on in between. Let's just do those in a different color, which are these smaller ones around here. These smaller waves, you could be looking at those. Sometimes if a wave's too small, you might want to drop down to a lower time frame that you can see them better. We're always looking for what we call the Goldilocks waves, which in this case are these ones that I've marked out in black over here. It's the ones where they're nicely pronounced, not too much noise, but enough data there that you can see the correct shape of the waves and you can use them well for your analysis. So those are the first 2. And the third one is, you're going to put it down as this, POLR, the path of least resistance. That's the direction that the price always wants to move in. So when we create our levels, whether it's 161.8, whether it's swing high low, trend line, reversal zone, whatever it is, that's an obstacle in the market for the price. We refer to that as resistance regardless of what direction it's in. I know people trade support and resistance, and support is what's under the price and resistance is what's above the price. We don't look at it that way. We just say that these things are obstacles in the market and or obstacles for the price, and that's resistance. Because then you get a path of resistance. Like for example, let's look at this point in time here when we had this candle that had closed through that 127.2. So once we are at this point here, we just do an arrow so you know, then what did we have? We had a path of resistance above the price here with these 2 levels. We had a path of resistance below the price directly under. We had the 127.2. We don't trade it from above it. So with extension levels, it's the only significant level that we don't trade from both directions. With the extension levels, we want to only trade it from the direction that the price approaches from coming out of the range. So that's going to give us this sort of shape. We only approach it from that direction. We don't trade it from that direction. Okay, but significant levels still have no directional bias in general, which means that although we don't trade it this way, it's still significant. So in this case, if the price is going to move down to that level, it's still significant at that point. So it's a path of resistance. So we've got that path of resistance there. We've got the path of resistance here that we saw before. And I'm sure there's other trend lines and stuff like that there, but we're not going to talk about those for now. We're just going to leave it as the basics, which means that we've already tested this path. We've seen it's failed. The price is now here. It's going to be attracted up to this level. So we've got 2 things at play here. We've got the push of the path of resistance underneath it. That's going to be pushing the price up, repelling it. And we've got the pull of this level up here. That's going to be pulling the price to it. And obviously once it gets up there, then that's the path of resistance right there for it. So at this point in time, during this candle, we're expecting there's a good chance the price is going to continue moving up. And with that, we're going to look at our first trade on the chart here. So dropping down to the hourly chart is going to be very difficult, but you've got to try to sort of not look at anything beyond where the arrow is. So at this point in time, let me just show you the date here. This was the 20th of September. And if we look over here at the daily chart, we can see, let me go back to the other daily chart we had. We can see that the 20th of September was this candle here, this bullish one. So we can see the price had moved down below the 127.2, and you can expect that there's a good chance it's going to be rejected from there. So let's go back to this trade. Now, looking at this hourly chart, remember, we're not looking at anything beyond the arrow there. We're seeing this really nice structure. Remember, now we've got the pronounced waves. We weren't seeing these waves on the hourly chart, on the daily chart, but we can see them on the hourly. I think it's quite clear why we've structured the trend line along here, but initially your anchor points would have been here and here. I always favor the candle bodies. So the first go-to would mean that you had a trend line like this. Candle bodies, candle body. Luckily for us, the next sort of end of the wave made it very clear for us where this trend line should be. Remember, at this point in time, you've got 2 anchor points, so it's an unconfirmed trend line. We want to confirm the trend line with the 3rd anchor point, and since it moves down like this, we have a very clear place that we're going to put the trend line. If there are longer wicks at the end of those candles, it could be a bit tricky to understand exactly where it should be, but at this point in time, we've had 2 clear waves, a very clear trend line, and so at this point, I'd say it's quite a strong trend line. So if you're looking at a double confirmation, it's going to be in the stronger sort of end of that range. So we get a close as a type 2. I'm just going to zoom in so you can really see it properly. Type 2 close on this strong trend line. You can see we've had another failure there, and we have this swing high. Now, someone on the forum did actually enter on this candle here, also because at that same point in time, there was a very small Fibonacci range going on here. And you can see that it was either this candle or the one before, I think it was this one, is failing at the level. So you can count that as a type 3 or maybe a type 1 with tolerance on the 161.8, and they took that entry. Unfortunately, they got stopped out. I believe it was by this candle, that is the entry candle in the next trade. But luckily for them, they had the confidence to re-enter, and that's a really important thing to do. So when you have a sort of bigger picture, so when we're looking at not just the setup, but the second point that we had, remember number 2, structure, that's amazing writing there. Where we have structure on our side and there's a bigger picture that we're looking at, in this case we're looking at the daily chart, we know it's going to move towards the 161.8, then there are times where you might want to take smaller exits, like take smaller losses and re-enter to try and find the bigger move. Because the benefit of trading on the hourly chart rather than the daily, if you've got a bigger picture view, is that your stop loss can be much tighter. So for example, if we look at this, entering, let's say on this candle and being stopped out there is 10 pips for potentially moving up to where the 161.8 was, which is like 70 pips or something. But if you're doing it on the daily chart, you have to look at things differently. I keep going to the wrong chart. You have to look at things differently, that if you're going to be entering long here, then you need to put a stop loss probably to allow it to fluctuate down to here. Now suddenly that's 55 pips. So instead it's better to enter on the hourly chart, but be willing to take those, like take a potential loss, a smaller loss, in order to find that proper entry. The reason you'd have to take that loss is because if we look at the candle, this bearish candle that's moved through the trend line, if that didn't pull back for a type 2, if it kept going and going and going, then you know it's broken the trend line. And in fact, even when it's down here, if it closed where that wick is, you'd expect it's going to continue with a lot of momentum, because when you have strong significant levels or you have strong structure, when that gets broken, it's going to continue with a lot of momentum because it requires that momentum to break through. So if it continues with that, then it's going to really fly. Which is one thing that we have to keep in mind with the daily chart here, is that obviously we're looking at, we have this double confirmation, or the 2 levels in the same place at this point here, but we have to be really tight with our stop loss because of course we're looking at an upwards sort of wave structure here. Higher highs, higher lows, and since we've had a higher low now, we're expecting a higher high. If it does break through this level at this point in time, it's going to go much higher. It's going to do it with momentum. And obviously there are spoilers here, because you can see when it finally does break through properly, we're getting some momentum there. That's partly because we had the Federal Reserve increasing interest rates. In fact, it's something we have to keep in mind during this, that we did have quite a few news items coming out during this time. We had the Federal Reserve raising interest rates. We had the Bank of Japan monetary policy meeting minutes. We had a leadership battle in Japan as well for the government. So there were quite a few things going on at that point in time. Anyway, let's go back to the hourly. So that was, there we got the stop loss if you would have entered that trade. But in any case, there's a re-entry here or an initial trade, depending on whether you took that first one or not. So here's double confirmation. We have that swing high. We have that's basically a type 3, but maybe you can give it some tolerance on this occasion, plus the type 2 on the trend line. Structure in our favor. So if we look at what we have here, what do we have? Let's go back to the pen. So we have higher highs, higher lows, and we're about to go long, which means that number 2, structure is in our favor. There's going to be more writing there. Number 1, we've got a setup on this strong trend line. Nice type 2 on there. So type 2, type 3 on a swing high is not the strongest. So in any case, we've got a setup that, let's say, if 10 is the strongest the setup can be, then I'd say this is probably like a 6 or 7, probably a high 6, low 7, let's say. Structure's good. And the third one, path of least resistance. So we know that we're looking at also the daily chart. We had the levels below. We also know that this trend line's a strong one, and there are these levels along here. There's sort of swing higher along there. There was the 161.8. I think that probably the path of least resistance, at least at this point in time, entering there, that the path resistance is below here and probably above this point here, where those swing highs are there. There's also a trend line running across, which we don't have there. So basically what that means, what we'd be doing here is looking to enter at this point. We place our stop loss based on where the path resistance is in this case, or based on a setup. We wouldn't base it on structure, because structure would mean having to place your stop loss down here, and that's too far for the price to go against us. So very tight stop loss, about 10 to 15 pips, and TMP is going to be this swing high up here. Okay, so that means that if we're having a stop loss from this point just below there, so probably about 9 pips. It's 9 pips stop loss. TMP is about 30 pips. So that's, let's say, a 3-to-1 trade just to TMP. But we obviously know that we've got something much stronger above the price, which is potentially getting drawn to that, the 161.8 that we had there. So I'm going to show you the price of that 161.8 again. That was over here. You can see it there. It's about 112.856. So what I'm going to do, just to show you, is I'm going to take this significant level we had here. I'm going to put 112. I think it was 876. Let's test my memory there. 856. Okay. So I will make the change, but I think it's pretty much the same anyway. 856. Okay, there we go. So that's where that 161.8 and the swing high is that we've mapped out on the daily chart. You can see what happens next. It reached up there. But basically, when we're looking at this trade entry here, our TMP is there 30 pips. But TMP does not mean that you're going to exit there. Your trade move potential is not your target. Your trade move potential is just to assess how viable the trade is. So we can see, as a worst case scenario, if the price moves in our favor and struggles at that first obstacle, it's still a 3-to-1 trade. Now, if it gets above that, then you're expecting it's going to move with momentum, because it's the high. It's going to be creating a higher high, and in which case we could get up to here, which is about 70 or so pips. So really good trade. 9 pips stop loss or 10 pips. I'd probably set it a bit like higher, because it's it's such a small stop loss. Otherwise, you don't want to get triggered by accident. So let's say 15 pips stop loss, 30 pips TMP. That's 2-to-1 with potential of making about 70. Now we can see what happens next is it breaks out of that swing high with momentum, as we would expect, breaks out and then tests from here. Now this period of time around here was, for UK, US, European markets, was the middle of the night. So most people, if you're long here, are going to go to sleep. And I suggest that you do sleep even when you have trades open, because otherwise you get into bad habits like I used to do, which is if you have positions open overnight or you're waiting for a setup, you end up checking the markets throughout the night and not sleeping properly. Or even more extreme, I used to have the laptop open on my bedside table and I couldn't sleep. And although it may seem like a good idea at the time, it takes a long time to shake off that bad habit because you've got into a strange sleeping pattern then. And even to this day, sometimes I wake up many times in the night and it's this habit of checking what the market's doing. And it's sort of like you're a mum of a newborn or something, waking up many times in the middle of the night to go feeding the baby. It's like you're checking up on the market. It's like checking up on your position like it's a baby. So instead, what I'd recommend around here is to place a take profit level near to where your target was and place a stop loss somewhere that's in profit but unlikely to get triggered unless the market is going really in a way that you would expect it to not go. Sort of a way that if you weren't looking at the chart, you would rather be out of it at that point. So if I zoom in, then I can talk you through where I'd be placing my stop losses here. So on this occasion, I'd say that my stop loss, so we've moved down. We know that the price may want to create a low, like it may want to retrace, but the structure's in our favor, so the chances are it's going to be a higher low. Now, if it gets all the way down to this trend line, it's still going to be a higher low, but you know, if you're sleeping for 6 hours, if it manages to move all of that way in a space of 6 hours and I'm not at the chart, I'd probably rather be out sooner than that point, because I think that there's probably a good chance there's something behind that movement that is going to cause it to break through. And if I'm not there to really check, like if I'm not there to manually close and assess the situation, I'd rather be out. And I'd rather not wait till it's all the way down to here. I'd probably rather wait until it's starting to break some of this path of resistance we've got here. So not that first one necessarily, because it's a bit too close to where the price is at that point in time. You're probably going to get triggered straight away. I'd say probably either this one, maybe that's not enough, maybe it needs to fluctuate a bit more, because you're talking from, let's say, this point in time. You can see on the screen there at the bottom, it's 10 o'clock at night, but this server time and UK time, I believe, is 2 hours less than that. So it would be 8 o'clock at night that we were down there. So by 9 o'clock, when this candle's opening, you know, maybe you want to give it a bit more than 8 pips. So I'd say I'd just put it between that one and that one, probably put it about here. That means that if it triggers the stop loss there, I'm going to have a profit of about 14 pips, which is not bad. And at the same time, I'm going to put my take profit just below where that 161.8 is in case it doesn't quite reach there. So I'm going to put it about here. And that's where I'd go to sleep. Now, someone on the forum, one of our course members, Chris P, is on the forum. He put his stop loss a little bit too tight and he got triggered and he got a profit overall of 25 pips. So 25 pips, not a bad profit at all. But on the forum also there was Nuno who opened the trade and he was still in over here where there was 70 pips profit. And this is the next thing I want to talk about here. So Nuno entered this trade expecting, sorry about the squeaky chair in the background, that seems to be my trademark. There's always a squeaky chair in the background. So Nuno had his plan that he was going to exit up here. It was a clear plan. He was going long from here. And when it got to the daily 161.8 and that swing high, he wanted to exit and potentially find a re-entry for a short trade. Now, you can see here, this movement up to here with the retracement, boom, boom, A, B, C confirmed. Look what happens. It's a type 1 close on the 161.8. So let me just point that out. Oh, that's a very big thing. ABC confirmed at the 38.2 there. And then we've got that entry up there. So for me, that point was my entry point. And I'm just going to switch on to the next chart to show. This was my entry point. Now, I took this trade. I know a couple of others on the forum did as well. As well as it being this 161.8, there was also one a bit further back. If you take, I believe it's something like this. Might be a bit difficult to see, but I'm just going to point it out with the pen to make it a little bit clearer. We have over here A, B. The C is confirmed on this level here. I think it's the 50% level. I know it's a bit of a mess, but you can see it there on that dotted line. Price moves through type 1 on the 161.8. So there's a double confirmation on the hourly, both from Fibonacci ranges for the last two waves, the medium wave and the smaller wave. And at the same time, we've got that double confirmation potentially on the daily, depending on how the daily chart closes. Now, remember, at this point in time, that daily candle is still in play. It's not, it's not closed yet. We don't know for sure it's going to be a type 1. It's this point here. This is what happened. Like, if we circle that candle, at this point in time, we are right up here on this candle, but it hasn't closed yet. So, of course, we're assuming by entering this trade that, first of all, we're going to use this trade as just the double confirmation on the hourly, which means that you base your stop loss, your TMP, and your exit on whatever's happening on the hourly waves. Especially when you've got such structured waves there, you don't want to bet against it. So we're going to be basing the entire trade on these waves, but also in the back of your mind, you know that if you get the reaction you expect to happen on this, you're going to get a type 1 close on the daily, which could potentially mean that there's a further move that could happen. But remember, you're going to use the hourly chart for assessing the trade. So Nuno at this point had obviously had this plan of exiting the trade up here. But then what happened, and I'm obviously naming his name because it's on the forum with that username. I'm sure he won't mind me talking about his trade. I think that he'll be happy that everyone gets the feedback. So at this point in time, he starts to be concerned because obviously he's in profit by about 70 pips at that point in time. He knows he had a clear plan to enter short, to flip the trade and to take the short entry, but it moved up with quite a bit of momentum. And if that momentum is going to continue, then that means we're going to push above this swing high. And if we push above that swing high, it means we've got even more momentum, and it could mean that his 70 pips becomes 100, 200, who knows how much. But I think with that logic, then it makes sense. It makes sense to at least try, to at least see what the reaction is there. So he stayed in. Now, the thing about this, there are two things. The first thing is that if you're staying in, but you're basing it all, like you've seen what's happening on the hourly chart, why not scale out a little bit? Why not take some of that profit, move the rest, like move your stop loss up to another profitable position, like let's say you take 50% of the profit, maybe even a bit more, maybe like 60 or 70%, probably with such strong setup, with so much confluence, I would take 70% or more at that point in time, not 50. So take that 70% and move the stop loss on the remaining 30% up to the trend line and keep moving it along the trend line. Because if that trend line is broken, you don't want to be in that trade anymore. And then just assess what happens. I think it's fine to stay in the trade, but you need to scale out at that point because there's so much against you. Unless, of course, you're trading over the long term, which is fine. You can trade sort of the medium term waves on the daily chart and you might be expecting a breakout. But if that's the case, then your plan from the start of the trade should have been different. But his plan at the start of the trade was to trade based on these waves, which means that at that point in time, at the very least, there should have been a scale out. So instead he stayed in, and the next mistake that happened is he didn't have a plan. When we enter a trade, we want to have a plan. Our plan doesn't necessarily mean, I'm risking 0.6%, my stop loss is 10 pips, my TMP is 20 pips. That's part of a plan, but that's like a small part of it. You need to have a plan for what you're going to do if the price breaks through the TMP, what you would do with your stop loss, what you're aiming for then, where your next levels are. Or if you haven't decided at that point, then if you decide when it gets to your TMP that you are staying in, so when this trade moves to here, if at that point you decide you're staying in, then you need to have a plan for exactly what you're going to do then. So what's your plan for if it keeps pushing up? What's your plan if it pushes down? What's your plan if it consolidates around here? You need a plan. The reason you need a plan before you make any decision is because when you're in the heat of the moment, when you have potential profit building up, or you had this big profit and it's reducing by 10 pips every half an hour or even quicker than that, you start to panic, you make the wrong decisions. You start thinking, I don't know what I'm hanging into the trade for. I don't really know what I'm aiming for here. So you need to have these clear targets before, because you can think much clearer, much more logically before you enter or before you make the decision. So before Nuno decided to hang into this trade, he should have already decided what he was going to do. But instead he panicked, and I'm not sure exactly where he exited, but it was after there was a bit of a retracement, and obviously he missed out on the short trade as well. So not only did it eat into his profit, which I think was fine, if he was aiming to get more out of the trade, but he should have scaled out. Not only did he miss out on that though, but he also missed out on the short trade, which he knew was there and he had planned for, and it would have been a lot more profit for him. Now, I entered that trade there. I can't remember off the top of my head the exact amount at risk, but looking at the different factors here, I look at the 3 different factors we said: the structure, the setup, the path of least resistance. I would say at this point in time, I'd be probably entering about 0.7% at risk. Now, the reason for that is that I have a maximum of 2% that I can risk with any trade, and obviously the minimum's 0% because you can't go below that. So let's say that it's like this sort of range of different percentages I can choose for a potential setup. So there's a midpoint here, and anything above that midpoint can only be for trades where I'm trading with the structure. So since I'm trading against the structure, which means against the trend, so this section is for, let's say, with trend, and this one is against ag trend. Okay, so there's the clear dividing line for me. We're against the trend. It doesn't matter how strong the setup is, I can't go above that midpoint, which is 1%. Now, if I'm going to risk the full 1%, it means the setup is extremely strong against the trend, or it could be, you know, mediocre or relatively weak or okay, but with the trend. Okay, so since we're against the trend, it means it's got to be super strong if I'm going to be there. But, you know, it is strong, but there's a few different things that would maybe put some doubt in my mind. So I would say it's probably about a 7 out of 10. So, sorry, 0.7% at risk. Stop loss, obviously, just above there, because once it breaks above, your setup's broken, the structure's maybe broken. This trend line, maybe you can base it on that, but that means that you're giving it a lot of space. Instead, probably I'd rather exit at that setup break. And then if it gets up here, you can always find a re-entry. Remember I said earlier, if you've got a potential bigger move coming, you don't need to be afraid to take small losses on the way to getting a big one. Because if you hang into the trade from there to there and you finally get the reaction, and let's say it's a good reaction, but it still only gets to here, then you're only making this much profit rather than all of this because you didn't take the smaller loss. So anyway, that's where we entered. Now, I exited very early. In hindsight, it's a bit annoying, but basically, I had places I need to be in the afternoon. I had things going on, a couple of other things that are just, you know, when you're trading, life doesn't stop, and there's certain issues and things that come up that you've got to deal with. So I exited somewhere along here. I think it was around the 1 to 7.2 because that was part of it. I was like, it looks like it's consolidating around here, and basically it was coming close to the weekend. You can see this gap here. That's where there was the close on Friday and a reopen. So we'll get into the afternoon or evening time around here. I thought I don't want to hold into this trade over the weekend because anything can happen. I'd rather be out, so I took that small profit there. So for me, that was, let's see, from an entry point of here, the close of that, to I think it was about here, 13 pips, maybe there's a bit more. I'd say I probably got about 15 pips profit on that. Not the best, especially given the setup. I'm not, you know, not proud of that one. But other people stayed in. I think Chris P on the forum stayed in, and I'm not sure what his exact entry point was, but talking about proper trade management now, looking at the structure, the setup, the path of resistance, your exit point should probably be, if you were willing to stay in over the weekend, either this point here where it's clearly struggling on this sort of swing high-low, where we can see that from both directions it's been relevant, but once it bounces up, comes back up here, then definitely this failure here, because it's such a strong trend line. Then you've also got on the daily chart the other levels that you've got down there, the path resistance stuff, that probably, that's where I'd be exiting, because now you can see that it's completed potentially another wave there. So that would be the exit, which would mean, and obviously you can scale out and stuff along the way, but let's say that that was the exit down there. It's going from there to, let's say it was the close of the candle, because you always want to exit at the close of a candle rather than halfway through. About 30 pips. Now at the same time with this move down, remember I said that you can see the smaller waves, that sometimes the lower time frames can give you more information. These were really nice structured moves on a 5-minute chart, and if I didn't mind this video becoming even longer than it is, I'd go and show you the 5-minute chart as well, but it'll be difficult to find the right place and start mapping that out. So we'll leave it for now. You can always go and find that point on the chart yourself and start mapping it. So that was two, I think, really good trades there. Not the most amazing profit. Obviously, this one that should have been from there to there about 70 pips. And then flipping it to take probably about 30 pips. So from two trades, both directions, 100 pips. Not bad at all. Now in terms of the daily chart, let's go back to that. If we zoom in, we can see that obviously we had that type 1 close, but then remember that was on the Friday, and when it gapped open, we always take the opening price rather than the closing price. And if you do that with this one, let me just show you where that opening price was in there. You can see that this candle would have been a bearish candle. Now, for those of you that really know the method properly, you'll know that we don't take a type 1 or a type 2 if it closes bearish after this bullish movement. So technically this wasn't a setup on the daily chart. You would assume, like, the reason we don't take that is we assume that the movement has already happened. We've already had setup completion there. So in that case, there is no extra daily sort of momentum there. You assume that the movement's happened. So once it reaches that hourly trend line, that's a good place to exit. And so that's when I thought that I was going to be doing this video. But then more stuff happened. So let's move on to trade number 3. Trade number 3, I've done with a red arrow rather than the blue ones, because this is one that I know a few people took, for course members, that I wouldn't have taken. So you can see the structure's continuing. This trend line is super strong at this point in time, but let's map out these waves. Wave, 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 wave. And then this one, if you're entering here, is because you're saying that potentially that's the end of the wave. Now, by the way, the waves are getting shorter, which is usually a sign, or can be a sign, that it's going to break out. And you can see that after this one, the wave got even shorter. Now, there's a few reasons why I wouldn't enter on this one, or why I didn't, because I did actually see it happening and I didn't enter. It's because, first of all, we had the US interest rate rise coming out later that day. And we knew the rates were going to rise. There was a high level of certainty about it. You know, the probabilities were good. So it's better not to be in it, because you know things are going to get shaken up later. And you've got to give enough time for at least one leg of the wave to complete. In this case, with the hourly chart, that wasn't going to happen. But the main reason is, we can see we've got this type 2 close here, or with tolerance, maybe you call it type 3. And it's obviously this bearish candle that we're looking at, because what happened after, we wouldn't have known. So we had a type 3 close, let's say, on that. We had the type 1 close on the trend line, but look at the size of that wick. The size of the wick, not only in comparison to the body of the candle, but more importantly, in comparison to all of the previous candles. When we have a wick this size, when it's a type 1, which is that bit there, we assume that the move has potentially already happened. Similar to what I just said then on the daily chart with that 161.8. So potentially the move has already happened. And when we see a long wick on the other side of a type 2, we think that potentially the price is now testing from the other side. So it's actually moving towards that level and testing from the other side. Remember that there's movements happening on the lower time frames, and this may look different on the lower time frames. So that's one rule that we have. And for me, this meant that it was too risky. Also with the TMP being up here. So your TMP would be this point, which is that swing high. And your stop loss would have to be at least there, but you maybe need to give it space to be a type 2 as well. So let's say down here, then suddenly that means that you're looking at a risk reward of, let's say, reward of 12.8 pips. Let's be generous and say 13 pips. And at risk, even to the wick, is 10 pips, but potentially a little bit lower would be about 15 pips. So let's say at best it's a 1-to-1 trade. And in this case, there was too much risk with the wicks, how they were. And I think it just wasn't a very good situation to go for. But people went for it, and the exit was up here at the trend line. There's a couple of different ways you can map the trend line. There's one way that makes this top bullish candle a type 2 closed, and I think that's where the exit was. So that would have been the profit from there to there is another 18 pips. But this is one that I wouldn't have taken. I've put it here as an example of how I wouldn't trade based on this structured moves that we had here. One that was, I think, a bit wrong, and it could have gone very wrong. Obviously, it ended up being profitable, but it could have just as easily been a loss as well. And in fact, the very first movement that happened is what we expect can happen in these situations, which the very next candle came back towards that trend line. Remember, the significant levels can attract the price as well. And when something closes up here, then there's a good chance it's going to get attracted towards it on the next candle. And that's what happened. So there was a good chance it could have closed to the type 2, maybe even a type 1 closer. And maybe that would have been a potential setup then. But this one for me wasn't. But then we had the interest rate rise. The market reacted. You can see this bearish candle here reacted in both directions, and the price broke through the trend line. So let's move on to the fourth trade, which was this candle here. Now this one I didn't see because the time of it was, so it's 3 server time, which means probably about 1 o'clock in the morning, but the close of it, so it would have been 2 o'clock in the morning. Had I seen it, and I mean, when I woke up in the morning, I straight away saw this and I was like, damn, why couldn't that have been a bit later? I definitely would have opened a short trade here. You can see that we have the double confirmation of this swing high low. So this was originally anchored to here, but since we've had this little reaction, I moved it up a little bit just because we always favor what happened more recently. So we had that type 2 close, the type 1 on this trend line. Now the things that we have to consider here is that the triad of price action would have been strong from 2 points of view. From the actual candle itself, look at the size of it relative to the previous candles, it's very strong. Although not so much compared to the one that broke out, but obviously we expect momentum when the candle's breaking out. So we can say that the candle in terms of the price has momentum during this candle. In terms of volume, I believe that it was pushing up higher. I know that volume with Forex is not, it's not something you can take as an absolute figure, but we use it relatively to the previous candles. And you can see in this case, it had a little boost up. The only thing is that the trend is down from this point. So you can see on the sort of shorter waves, it's lower highs, everything was moving down, and it's only just started to move up. So 2 out of the 3 from the triad are against you. I would say with the market being sort of a light market since it's during the Asian markets, then I think that I'd probably go for this. Like if we're on the other side of the trend line, I'd go for it. The stop loss only needs to be tight because it needs to be based on the setup and the path resistance. So let's say moving it, I don't like, you could put it as like 4 or 5 pips, but I never like to do that because I think you're going to get triggered by accident. I prefer to put a little bit more on it just in case. So in this case, I'll probably put like between 8 and 10 pips. It's going to be a very small trade. And you can see what happens. It moves down like this. Now, obviously, it starts to move back up afterwards, so there's a chance it could have been a break-even stop loss hit there. Like once it starts moving down, you move your stop loss to break-even. Could have been a break-even stop loss. But there's also a chance that because of these small movements and with it being a light market at that time, you could drop down to the lower time frames and assess what's happening there and get an early indication that it's going to be moving against you. But overall, because I wasn't there for this trade, I don't want to commit to saying what my trade management would be. There's also other analysis you could put on here, micro trend lines, swing lows and everything. Like for example, you can look at these swing lows here and see as we're approaching that, or even this one up here, that was the same one that we were using before. There's many different things you could be looking at that in hindsight, it would be very unfair for me to say one way or another. So I think just to be fair, let's assume that it hits stop loss at break even. Because even if you kept your stop loss, let's say you entered here, even if you kept your stop loss at the original place, once this candle closed like this, then because of the triad of price action, there's no wick at the top, it's a very bullish move, you'd probably be exiting anyway. So let's say, to be fair, it's a break-even trade there. But overall, I think with these trades that we've had some really nice situations. And the funny thing is, the structure continues. Now, what I want to show you is what I think is going to happen next. Or not what I think is going to happen next, but what I think the next potential big opportunity could be here. So hopefully this structure continues on the hourly, so we can keep mapping out the waves here, and you should keep an eye on that because it's a great learning opportunity for you. But if we look back to the daily, I'm going to use the next daily chart. There's a situation that's building up here. So we obviously broke out of the previous range that we had. So it wasn't unexpected because, like I said, it was a type 1, but it sort of completed its move and it's pushed through. Well, now we have this range here, which is taking A, B. We've got the C point confirmed there at the 61.8, and we've just broken out of this range here. And it looks like we've got enough momentum to potentially reach this extension level up here. I hope you can see it. It's the 127.2, that dotted line along there. And the colored boxes that you can see are the reversal zones that I've put in. Now, some people don't want to use reversal zones. So if that's the case, then just don't use it. There's a more precise level you can use. But if we look over here, this is beyond just being a normal reversal zone, because with normal reversal zones, what you'll get is maybe something like, I don't know, I can't see another one directly there, but you'll maybe get like clusters, like what's happening around here. Like, you know, the wicks hit this area, it reverses a little bit. You don't tend to get such big pronounced waves like this each and every time. You know, these are the big movements that have happened all from this same area here. So I've put two different zones there. With reversal zones, it's sort of like a heat map. You have the lower zones and you can add more layers if you need to. So that first color before the red line, just zoom in so you can see it. You see this red line here? That's anchored to this swing high, okay? Because it was tested again there. It was tested again over here. So if you want to be precise, you can use that swing high. So ideally what would happen is we close as a type 2 on the 127.2 and a type 1 on that swing high. That would be perfect for potentially finding a short entry, and hopefully the structure is still continuing on the hourly chart to make it even easier for us. But there's another layer that I've added on top, and it's quite a big one. It captures all of these movements that happen with the wicks, although those are already captured by the candle bodies in the lower part of the zone, but it catches these movements up here as well. Now the reason I've added those is because you can also see, obviously, if we break out, we've got the 161.8 up there. So let's say we don't get a setup here, there's a chance we get the type 1 on the 161.8 and a type 2 at the top of the reversal zone. Keeping in mind as well that the edges of any zones in the reversal zone, any of the layers, the top and bottom are more significant than the middle, but we can still use the middle. And also, this is not a range that I'd particularly want to use in isolation, but it just sort of adds to the confirmation. It's not confirmed the best way, but regardless of how you anchor it, we're looking at the A, B, and it's not really confirmed nicely at the C point, but there are different ways you can get nice confirmations or not. We have the 127.2 that was exactly in line with the top of that range there, and we obviously had the reversal there, so that confirms this range. Yes, we've re-entered this range, which usually means that we don't want to use it again, but this is just to add some more confidence for us. And you can see what happens, we get this 161.8 up here as well. But like I said, there are different ways to map it out. This is my favored way, but you can also do, for example, like this. If we put the, sorry, apologies, I just realized. So the 161.8 isn't this top one, it's this one here. That's what I was pointing out. It's at the top of the reversal zone, okay? So there are other ways that you can map it out. You can also push this up to the wick here, in which case you get the 161.8 exactly in line with this one. Remember what we said about things being beyond a coincidence. When the market's really respecting the Fibonacci movements, you tend to find a lot of confluence from major waves. Now, obviously, you can put in minor little ranges like, oh, we've got confluence up here. That's not how it works. We're talking about the same waves from the same structure. Just like in this first trade, the second trade, this one up here, we had confluence between this wave and this wave that both gave the 161.8 there. Likewise, we've got the same thing happening up here from these two waves. So that's what I'd be interested to see. Either I want to maybe trade towards those levels if I think the price is going to be attracted up to there, but more importantly, I want to look for the short opportunities around some of these areas up here, while keeping an eye on the fundamental situation, because obviously that's going to drive it a lot when you're looking at the long term. But in a nutshell, it's not a nutshell, in a long video, this is the situation right now with USD JPY, and that's what happened so far. So guys, I'm sure I missed out some things. I'm sure some things I wasn't clear enough on, but the more we do videos like this, the more you pick up on it. And if you are a course member, if you've at least done the Inner Circle mini series there, then you'll understand what I'm talking about here. And this is a really good market to go and do some back testing on this weekend and really see like the different opportunities that were there. Maybe look at different time frames as well and see what was there then. But when markets are like this, it just makes our life so much easier, and it shows you how you just don't need to force things. You can wait for the right trades to come to you, and those are going to be much more profitable for you. And it means that, you know, you don't need many of those each month to really make a good profit over the long term. So guys, if you've got any questions or comments, please leave them below. Remember to hit that thumbs up button to let me know that you want more videos like this. And don't forget that little comment that I said before down below if you want to see the videos of my individual trades, even if it's just a quick 1 or 2 minute video each time. I know I didn't go much into position sizes and stuff like that in this one, but hey, why overdo it in one video? But if you made it to the end of the video, you're still watching now, then I appreciate you watching. If you're not already subscribed, make sure you hit that subscribe button, switch on notifications, and go and have a great weekend. Take care guys, thanks a lot for watching.